Hello, everyone, and welcome to the No Huddle Market Update. We're calling it the No Huddle Update because I'm going to try and fly through a bunch of information here, keep it as short as possible, but also try to cram as much good, valuable, useful information for your portfolios and retirement planning and informational purposes as we go into the summer months. So let's just go ahead and get started. First of all, just want to make sure we update or modify and optimize your viewing experience. At the bottom right, you'll see a little gear down here at the bottom, little HD symbol. What you want to do is change that to the highest resolution you can. Don't let it do the auto thing. That way, some of these charts will be a little bit easier to read as you go through them. All right, first of all, this is how our quarterly scouting report started about a month and a half ago or so. Not a whole lot's changed, but at the same time, a lot has changed. So first of all, just want to go through the old statistics that I have in the past. 2015 was a pre-election year. Pre-election years are typically the best year for the stock market of the four-year election cycle. Not only was 2015 a down year, but it was the first down year since 1939 when Hitler invaded Poland. Second statistic here, the Santa Claus rally. This is the last few trading days of the year and the first couple trading days of the new year. Every year, the average return of the Santa Claus rally is about 2%. This year it was down 1.4%. The first 5 and 10 days of this year were the worst first 5 and 10 days for the market in history. January was the worst January for the S&P 500 since 1923. January was also the worst month for the Dow since 1900. The last time a stimulus package ended, which was on October 14th of 2014, so it's been just over 18 months now since the last stimulus package ended, the S&P 500 is only up 1.09%, or we'll just call it 1.1%. So while there's been lots of ups and downs, not a whole lot has happened this last 18 months when we kind of look in the rearview mirror. The other thing to keep in mind is when markets do crash, when they begin to crash, you kind of have to look under the hood of the car to see what's going on. And the first thing that goes are small caps. So 53% of small caps are now in bear market territory, in other words, down 20% or more. 30% of mid caps are down 20% or more, and 13% of large caps are already down 20% or more. And what's important to understand about this is that most people look at the Dow, which is 30 huge stocks, or the S&P 500, which is a cap-weighted index, which weights the highest, biggest companies on the index. So these smaller companies don't get a lot of weight. So even if they go down 10, 20%, you're not going to see it in the index as much as you would see it, say, if it were a large cap stock, because obviously, again, large cap stocks are weighted heavier on the S&P 500 cap-weighted index. Second to last year, we are now living in the second longest bull market in history, and that's not to say that we should go cheerleading and looking for it to overtake the number one slot and become the longest bull market in history. Instead, I think this is another reason to be concerned, another reason to be worried that maybe it's time that this thing eventually roll over. And then last but not least, I hate the cliche here, but the whole saying, sell in May and go away. All right, so let's talk about that for a second. So sell in May and go away. What is that? If you were to invest $10,000 on May 1st of 1950, and whatever it was worth on Halloween of 1950, you sold it and you went to cash for the winter. And then the following May, 1951, you invested the proceeds, invested in May 1st, sold October 31st that year, and you did that over and over and over again, basically buying in May, selling on October 31st on Halloween. You would actually have lost $323 since 1950 using that strategy. To the contrary, if you were to invest that same $10,000 on November 1st of 1950, and if you sold that same, whatever the proceeds were, let's just say you sold on April 30th of 1951, and you did that every single year, basically going to cash for the summer and being invested in the wintertime, that same $10,000 has grown $843,425, so over $843,000. Now, that's the environment we're living in right now. Does that mean the market has to go down this summer? No, it doesn't. Does that mean the probabilities are high that things will probably get worse this summer versus better? Yes. Does it mean that we should not invest any of our money because of a study like this? No. This only has anything to do with stocks, first of all. This has nothing to do with commodities, currencies, bonds. It actually has nothing to do with international stocks either. But at any rate, we just need to be cognizant of indicators such as this or statistics such as this so that we can make sure that we're stacking the deck in our favor as opposed to doing the opposite. Here's another study. Also, Stock Traders Almanac here. The red line is the market today. That's this year, so 2016. The black line, which is what I want you to focus on here, is the average performance of the 8th year in a 2-term presidential election cycle. We haven't had a lot of 2-term presidential election cycles, but when we have, the average performance is actually negative 15.4%. So half are better, half are worse. But what we're looking at right now is a peak typically on the average here, right into April. We peaked in later April. Now we're in May. Kind of things are coming back down. So if this thing kind of tracks the way the average goes, then obviously we're not in for a really great rest of the year this year. This is the same chart, except we're looking at the NASDAQ now. So here we are, the red line today. This is the 8th year average of a 2-term election cycle in black for the NASDAQ. And you can see how it kind of holds through all the way to September after peaking in March and then kind of follows through to the downside through the end of the year. Here's another chart I think is really important. This is the S&P 500, the dark black line. So that this is basically the market as it's gone up, pulled back in August, started to go back up again, failed, lower low, started to go back up again, higher high, and then ultimately printed another lower high here just in April. So what I want you to pay attention to, though, is the earnings. So this dotted line is the earnings of S&P 500 companies. So basically the companies, the 500 companies in the S&P 500, this is the earnings. And they've gone down 18% since peaking early last year, while the market has continued going sideways, basically, with a downward bias, of course. We're still, like I've said before, we're in a long-term downtrend at this point. But you can just see here how earnings have actually gone down ahead of price. And I put a little note down here, from 2000 to 2002 and 2007 to 2009, the S&P 500 index fell first. So in other words, the price fell first, then earnings fell. Whereas this time, earnings are falling first while the market stays up. Now, could that have something to do with Fed intervention? Maybe. I don't know. And honestly, it really doesn't matter. But I just think, again, this is something we need to pay attention to when looking for evidence of whether or not the market's going up or going down from here. Here's another long-term chart. I won't get into too much detail, but basically this chart measures the long-term percentage of all equity, or in other words, stock, mutual funds, and ETFs that are on a higher high. When it's going down in O's, that means that the percentage of mutual funds and ETFs around the world that are on a higher high are going down. In 2002, right here, you can see how after peaking in 2000, it went all the way down after a little bounce, ended up following through to about only 10% of equity funds around the universe were trading on a higher high. That's it. In other words, 90% were on lower lows. Then, in 2002, it just screams up. From 2003, 4, 5, 6, all the way to 2007, reverses down again, heads all the way down here till we saw a little bounce about halfway through, crosses below the 62% line, and then again follows through the downside all the way till we get a bounce, and then we get 10% again. So we're back down to 90% of funds, both ETFs and mutual funds, on higher highs. On lower highs. Then it screams up again. All the way from 2009, 10, 11, we get to this point of Fed intervention where you have stimulus packages and QE. Things are bouncing around like crazy. And then finally, just this past year, we end up getting that cross below 62% again. We get a bounce, and we don't know where it's going from here. I suppose it's always possible it could continue northward from here, but basically we're back in that danger zone, that red zone, where we need to be extremely careful, again, looking at other indicators, looking at the orchestra of indicators, if you will, to make sure that we're doing the best thing with our portfolio. Market goes down. Here's a longer-term 20-year chart of the market. S&P 500, tech boom, peaks out in 2000. It takes, I just want to reiterate before this wasn't kind of the point of this slide, but I want to reiterate here that, as I've said in the past, that before the market really started to decline, it peaked out here in 2000, early 2000, started going up and down, kind of rolling over, but general up and down, lower highs, lower lows, lower highs, lower lows, and so on, until finally just accelerating to the downside, volatility picking up, basically buyers running out, no more buyers to buy what the sellers are selling, and then we see a 47% decline from top to bottom. Similar, 2003 to 2007, market peaks July. All of a sudden, again, it takes almost a year and a half before the market finally starts to really accelerate to the downside. So again, people, the market takes time to crash. I'm not predicting it's going to, but I'm saying if it does, don't think that just because it's going up and down right now, like it is right here, this is the market today, up, down, peaking, lower lows, lower highs. That doesn't mean that we're going to start screaming to new highs and that this is going to be the resumption of some new bull market. Here's a longer-term trend for those of you who are interested in how low I think things can go. This was the previous support. This red line was the previous resistance line for the market when it was bouncing off its ceiling in the past. 2000, bounce. 2007, bottoms, bounces. Crosses north of that line, indicating, we're in a call it a bear rally, if you will, in a secular bear market, peaking out here in 2015, May, and then downward bias. Now, how bad could it get? Well, if you use that old level of resistance as current support for the market, then we should go down anywhere between, call it, 15, 23% or so, using 1550 as a line in the sand on the S&P 500. If it crosses below that line and then bounces and confirms a downtrend from there, we don't really have any clue how low it could go. Now, so I'm going to call this the best case downside objective. Worst case downside objective is really ugly. I put this chart on Twitter and Facebook, I think, on May 4th. But anyway, this is the same chart. It's a candlestick chart, but this is what's called a broadening pattern. And I apologize for the comic relief here. I know this is supposed to be more of a professional screencast, but a broadening pattern looks like this. It broadens. And over time, you can see that the potential objective, this is the Dow Jones Industrial Average, so the Dow could go as low as about, call it 6,000 to 6,500. Do I think that's going to happen? Well, I hope it doesn't. But again, if you know anything about our firm and our strategy, you know that hope is not our investment strategy. So obviously we're doing things about this. Here's the market today. Actually, it was the market close May 19th. That's yesterday. So today's the 20th. This was the market close yesterday. What I see on this chart is a left shoulder, a head, a right shoulder. Here's our neckline. Head and shoulders patterns are very, very, very strong, whether they're bullish or bearish. In this case, this is a bearish head and shoulders top. And you can see here a little break yesterday. Now, I don't think we have confirmation quite yet. Confirmation meaning it has to stay below that line for more than just, call it a few hours like it was yesterday. So we need to see confirmation below that line before this really kind of accelerates to the downside. But if you look below in these other indicators that I follow, the ADX line measures trend or strength of trend. When this goes up, it means whatever the current trend is increasing. Obviously, the current trend is down, so this was indicating an increase of a downtrend. MACD, moving average convergence divergence. This is a sell signal right here when the fast line crosses below the slow line, and then it's expanding and accelerating to the downside. So momentum is expanding to the downside. And then lastly, I don't usually show anybody volume characteristics, but this is PVO, price volume oscillator. And it's indicating to us that while the market was going up here, so while it was trending up off the February lows, volume was decreasing, which indicates less enthusiasm or less interest in the uptrend. However, as things have started to kind of stall again and create another short-term downtrend, volume has picked up, which indicates enthusiasm in the downtrend. That's not good for the market. If we scan back to an aerial view of the market, so we're looking at the 30,000 foot view here, what I want you to notice, again, this big long uptrend, but there's a punchline. This is not the market today. This is the market in 2008. And this is what happened afterwards. It took a really long time, you can see here, from 2007 all the way until partway through 2008, where things really kind of just started after a bounce here, halfway through 08. We're almost, call it, back to the midline of the 2007 market. Then the bottom just falls out. This is the market today. So, could this be a triple top? And we're falling to new lows from here? Maybe. Is this a double bottom? Doesn't really look like it, but could it be a double bottom and now we're screaming to new highs? I think the probability is very low. I think the probability is higher for a market to drop from here. So there's just to kind of wrap things up here, there's 3 ways to manage your retirement money. You can put it under your mattress, which will work just fine as long as you're rich enough to outlast inflation, because obviously inflation can only go up from here, and it's going to beat up your purchasing power. Second thing you can do is buy, diversify, and hold for the long term, which is what I did for the first 7 years of my career. This will also work as long as you've saved more than enough money for retirement. And of course, you can never sell. You have to stay diversified. You have to stay in the market. You have to stay in that little pie chart. Otherwise, the whole thing blows up in your face. So you can't screw it up by selling. Or you can do what we do, which is trend following technical analysis. And we feel that while no strategy is perfect, the strategy does the best job of stacking the deck in our favor, avoiding having to swim upstream. And again, while we won't miss every 5 to 15% downtrend in the market, the goal is to avoid the big market crashes. So game plan going forward, just quickly, before, again, we wrap things up here. First of all, back in a couple months ago, I had stated on our last screencast that we were covering the brake pedal. In other words, cautiously, heavy in cash. We were out of the stock market for the most part, but we were covering the brake pedal. And at this point, I would say that we're stepping on the brakes, turning around and going home, because it's just not worth sitting in traffic anymore. What I mean by that is we're long bonds, or when I say long, what I mean is we own bonds. So we have bonds in our portfolios, we own commodities, so agricultural commodities, wheat, corn, oil. We own some volatility, and this is a little kind of confusing to explain in a screencast like this, but basically we own the VIX, which when volatility increases, when uncertainty increases, the VIX goes up. We are short U.S. and international equities, so short the U.S. stock market, we're short emerging markets, short Japan and China. And what that means is if the market goes down, that we make money. In other words, we're betting on the market going down from here. Our more conservative portfolios, we are not short the market in those conservative portfolios. We just have your heavier cash positions. And the one little caveat here is we always have to, as technicians, as a market technician, my job is to make sure that I'm always staying agnostic. I'm not married to a downtrend. I'm not married to an uptrend. So in other words, again, staying agnostic, I have to make the case for the bull, which is, what happens if I'm wrong? What happens if, in light of all this evidence, that I'm wrong? And if that's the case, I think it has a lot to do with the Fed. So if Janet Yellen decides she's going to drop rates from 1/4 point to 0, if she decides she's going to get on TV next month and says that she's going to leave rates at 0 through the rest of the year, that could cause the market to rally in the short term. Or worst case scenario, in my opinion, if she decides that for whatever reason, I can't imagine why, and it'd be a good reason, but if she decides she wants to do another round of quantitative easing, QE, in other words, a stimulus package, then that would obviously, well, I shouldn't say obviously, but probably send the market higher. So we would obviously have to stop out. In other words, we'd have to sell a lot of our positions that we own now, a lot of our investments we own now, and we would have to probably heavily consider getting back into the stock market just for the short term between now and call it towards the end of the year to take advantage of such a rally caused by outside intervention. But I'm not going to get into any more details than that. If you have questions, please give me a call. Email me, email the office if you have any questions about any of this stuff. We have a lot of questions these days about the presidential election. I'm happy to talk about that, but again, I planned on keeping this short, and already it's getting a little too long here. So let's go ahead and wrap this up with a quote. Some of you have seen this before, but I just think it's great. Warren Buffett, most people see Warren Buffett as a buy and hold investor. They think that all he does is buy stocks, buy companies, and hold on to them forever, and that's not true. In fact, how about this for a quote? So this is Buffett in 1988. The disservice done students and gullible investment professionals who have swallowed MPT, which is modern portfolio theory, or in other words, buy and hold diversification investing. So the service done students and gullible investment professionals who have swallowed MPT has been an extraordinary service to us meaning, Berkshire Hathaway, the smart money. In any sort of contest, whether it be financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it's useless to even try. And what that's saying there is that the industry, Wall Street, has taught the average investor that it's not worth trying to do anything better than just sit in the market and ride the wave. And we just simply disagree. So thank you for watching. I'm going to go ahead and end here. If you, again, have any questions, feel free to check out our website for other commentary. I write a weekly column on Wall Street Journal's Market Watch if you want to check out more details there. Follow our Facebook page. I occasionally post charts there. I try to keep them simple. For the Twitter crowd, I post probably my more sophisticated stuff there. If any of you want to follow my personal Twitter page, our business Twitter page as well, you can follow that as well. If you want to subscribe to this YouTube channel, please do. I'd appreciate it. Feel free to share this video and others we've done with your friends, coworkers, family members, people that you care about. And I really appreciate you taking the time to listen, and we will see you next time. Thanks.